Hey everyone, this is Beinsure Talks, Insurance and InsurTech Insights. Today we'll be talking about how the digital transformation of the insurance industry is completely rewriting the rules of risk. I mean, imagine building this state-of-the-art impenetrable fortress.
Right. Stone walls, the works.
Yeah, stone walls, a moat, armed guards, all to protect a dusty old stack of DVDs. But then you leave your online banking password just scribbled on sticky note at a busy coffee shop.
It sounds absurd, but that is exactly what the global insurance industry is grappling with right now.
Totally. And that's our mission today. We are taking a deep dive into a stack of sources, specifically the Swiss Re Institute's Sigma report and their Country Digitalization Index, to track this massive migration of global wealth.
Because the value of the global economy has fundamentally shifted. It's moved away from physical, tangible things toward invisible, intangible assets.
And this custom-tailored deep dive is going to show you exactly how this invisible shift is forcing century-old legacy insurers to basically rip up their playbooks. They're having to team up with nimble tech startups and use AI to track your daily habits just to survive.
The scale of this migration is honestly hard to overstate. I mean, for centuries, the entire foundation of insurance was built on one very simple premise.
Protecting physical objects, right?
Exactly. Cargo ships, textile factories, brick-and-mortar storefronts, cars.
Yeah.
But when you look at the modern economy, the bulk of a company's actual value just isn't locked up in physical machinery anymore.
All right. It's all intangible.
Exactly.
Yeah.
Today, business value comes from data architecture, brand recognition, consumer trust, software scale, and network effects.
And let's look at the actual numbers from the Swiss Re Institute here, because they paint a really stark picture of that DVD fortress analogy.
Oh, the numbers are wild.
They really are. According to their data, 58% of tangible physical assets are currently insured globally. But when you look at those intangible assets, the data, the brand value, only 17% is covered.
Right.
So basically, 83% of the modern digital economy is just sitting out there totally exposed. I want to understand the mechanics behind this gap. I mean, why is it so low? Is it just because traditional insurance companies don't know how to put a price tag on an abstract concept like trust?
That's the core bottleneck, yeah. The pricing mechanism. The traditional insurance model relies heavily on historical actuarial tables.
Meaning they look at the past to predict the future.
Exactly. To underwrite a physical factory against a fire, an insurer doesn't just guess. They analyze like 100 years of recorded data, fire frequencies, the combustion rates of specific building materials, average fire department response times for that specific zip code.
So it's very precise.
Highly precise. It lets them calculate the exact statistical probability of a fire and the precise cost to rebuild. But calculating the financial damage of, say, a loss of trust, that requires an entirely different methodology.
Because you can't really measure trust with a tape measure.
Right. Consider a modern platform that's built entirely on connecting independent supply with consumer demand digitally. If they suffer a massive data breach, calculating the exact dollar value of the users who, delete the app, never return, and tell their friends to avoid it, that is incredibly difficult.
Yeah, that makes sense.
Without that 100-year historical baseline, underwriting that abstract loss becomes just a monumental mathematical challenge.
And that lack of historical data is huge. But the sources also point out that this isn't just an issue of insurers struggling with math. It's a macroeconomic issue, right?
Yeah.
Tied directly to the digital infrastructure of the countries where these businesses actually operate.
Very much so.
The Swiss Re Country Digitalization Index maps this transition across 29 different countries, and the variations are pretty striking. South Korea, for example, has consistently held a spot in the top 3 from 2010 all the way to 2023.
Yeah, and South Korea's placement there highlights how macro-level digital infrastructure dictates the potential for these new insurance markets. The index measures success across 3 main pillars: access, utilization, and innovation.
Okay.
South Korea excels because its population highly utilizes digital tools, and its businesses invest heavily in innovation. But the data also reveals some underlying vulnerabilities, even for the top players.
Right. The report specifically notes that South Korea has actually seen a relative decline in its fixed broadband coverage compared to other nations.
Exactly. And furthermore, the index suggests they need to increase their market openness, specifically by growing their share of what they call digitally deliverable commercial services.
Let's clarify that term for the listener real quick. When the report says digitally deliverable commercial services, We are talking about businesses that operate entirely through the internet, right?
Yes.
Things like remote IT consulting, cloud computing, digital marketing, or software as a service. Basically, things that don't require putting a physical product on a cargo ship.
Correct. It is the purest form of intangible commerce. And when we look at how other massive economies handle this, the landscape gets even more complex. Take China, for instance.
Okay, yeah.
They lead the pack globally in filing ICT-related technology patents.
ICT being information and communication technology, right? Covering everything from 5G routing to AI algorithms.
That's spot on.
But the report notes a massive caveat there. China files the most patents, but they actually lag in the proportion of business R&D spending relative to their GDP. So why does that discrepancy matter to the insurance industry?
Well, it matters because filing a patent is, relatively speaking, pretty expensive. But commercializing that patent into a viable revenue-generating business takes massive research and development capital.
Oh, I see.
So if a country is filing patents but not spending the GDP to turn them into functioning commercial assets, there's less actual digital business value being created for insurers to cover.
It's just ideas on paper, not insurable businesses.
Exactly. It creates a disconnect between technological invention and insurable commercial application. And then we see an entirely different paradox in India.
Right. India is sitting near the bottom of the 29 countries on this index. The sources note they struggle heavily with basic mobile broadband access, which seems like, the absolute prerequisite for participating in any modern digital economy.
It usually is.
Yet, despite that huge infrastructure bottleneck, India actually excels in those exact digitally deliverable commercial services we just talked about.
Yeah, and the contrast there proves that you can't simply build a modern digital insurance product in a vacuum and expect a seamless global rollout. The digitalization of the insurance industry is entirely constrained by the physical and regulatory infrastructure of the country itself.
Give me an example of that.
Okay, so if an insurer attempts to launch this revolutionary data-heavy mobile claims app in a region suffering from poor mobile broadband penetration, the sophistication of the software is totally irrelevant.
Because no one can load it.
Right. The product will fail. The infrastructure has to exist first. And where that infrastructure is highly developed, this interconnected digital economy is creating entirely new pools of risk that just didn't exist a decade ago.
Which logically brings us to the dark side of this migration to invisible assets. Because these new assets live entirely on servers and in the cloud, they generate vulnerabilities that a standard commercial property policy just wasn't built to handle.
No, not at all.
The global interconnected economy has caused cyber threats to absolutely skyrocket.
And that escalation in cyber threats has created a mandatory pivot for the industry. Insurers are now stepping in to provide highly specialized coverage aimed explicitly at protecting digital infrastructure.
Like mitigating ransomware attacks?
Yes, ransomware, and covering the massive liabilities associated with lost customer data. Cyber insurance is rapidly transitioning from this niche add-on to a foundational necessity for any modern business.
Wow.
But the digitalization of risk goes way beyond just hackers stealing credit card numbers. It's fundamentally altering everyday operational risk. And that becomes incredibly clear when we look at the sharing economy. Consider platforms like Uber or Airbnb.
Okay, yeah, this is where the shift from physical to digital risk really hits home for anyone listening, because these sharing platforms rely entirely on their intangible brand reputation and their software networks to connect you with a service.
Exactly.
But if you decide to rent out your own apartment on Airbnb for a long weekend, you are suddenly operating a commercial enterprise out of your living room.
Which is a huge shift.
And the sources indicate this is a massive blind spot. I mean, does the average person even realize that their standard homeowner's insurance policy likely leaves them completely exposed the second they hand over those keys?
The vast majority of consumers are entirely unaware of that exposure. Personal insurance lines, your standard homeowners, renters, or personal auto policies are explicitly written to exclude commercial usage.
Because the math is different.
Entirely different. When an actuary calculates the premium for your homeowner's policy, they are assessing the risk of a single family living in that space. They're calculating the likelihood of a kitchen fire from making dinner or a burst pipe in the winter.
Right.
They're absolutely not calculating the operational risk of 50 different strangers cycling through the property every year, treating it like a hotel, throwing parties, or potentially suffering a severe injury while paying to be on the premises.
Wait, let's look at how that actually plays out. If a guest slips and falls, and the homeowner's policy denies the claim because it was a commercial transaction, the homeowner is suddenly facing personal financial ruin.
Exactly.
So how is the insurance industry adapting to this? Are they forcing regular people to buy massive commercial property policies just to rent their house out for a weekend? What does the solution actually look like?
Well, forcing consumers to buy full commercial policies would destroy the sharing economy overnight. Nobody would do it.
Right, it'd be way too expensive.
So instead, the industry has been forced to shift its business mix and develop hybrid policies. And these policies rely on digital tracking to dynamically shift coverage based on real-time usage.
Oh, interesting.
Yeah, for example, in the ride-sharing space, your personal auto insurance covers you while you drive to the grocery store. But the moment you open the rideshare app and accept a passenger, a commercial policy provided by the platform, or a specialized hybrid policy kicks in.
So the coverage literally toggles on and off based on digital signals from your phone.
Exactly.
So because the insurers don't have historical data on how often an Uber driver gets into an accident versus a regular commuter, they need continuous real-time data to know exactly when the risk profile changes.
You hit the nail on the head.
That perfectly explains the industry's massive push into connected technology. We're looking at a heavy reliance on wearables, sensors, artificial intelligence, and the Internet of Things, or IoT.
Right, because the integration of continuous data streams is replacing the reliance on those old historical tables.
Yeah.
Consider the evolution of life and health insurance.
Okay.
Historically, underwriting involved a static snapshot. You took a blood test, answered a medical questionnaire, and the results of that single day dictated your premium for the next 30 years.
Even if you started running marathons a year later.
Exactly. But today, wearable devices provide a continuous stream of biometric data. Insurers can now analyze resting heart rates, daily exercise metrics, and sleep patterns.
And adjust based on that.
Yeah, this allows them to make highly informed, dynamic healthcare funding decisions based on continuous reality, rather than a static snapshot from a decade ago.
And the sources show this extends way beyond just personal health. Sensor technologies are being deployed across transportation and industrial operations to proactively minimize hazards before they even happen.
It's a huge operational shift.
Let's look at how this changes the mechanism of a claim. Instead of using past data to guess if a factory will flood, an IoT sensor on an industrial water pipe monitors the structural integrity continuously.
And the mechanism there represents a fundamental shift in the whole business model. Because if that IoT sensor detects a microscopic drop in pressure, it doesn't just record the data and sit there.
Right.
It sends a signal to a central AI system. The AI can instantly cross-reference the factory's operational protocols and automatically shut off the main water valve to prevent a multi-million-dollar flood, and then dispatch a repair crew.
Oh, wow. So no humans even need to intervene.
Exactly. And importantly, it transforms insurance from a reactive industry, one that simply writes a check after your factory is destroyed, into a proactive risk management partner that prevents the destruction in the first place.
I mean, I definitely understand the financial benefit there, but we have to acknowledge the tension this creates. Moving from a yearly checkup to having this tiny paramedic on your wrist 24/7, or moving from an annual factory inspection to continuous sensor monitoring.
It's a big change.
Doesn't this level of real-time tracking fundamentally change the relationship between you and your insurer? It shifts from a passive safety net to an active surveillance system.
That trade-off between customization and privacy is the central tension of modern digital insurance.
Yeah.
The data dictates that if you want highly personalized, usage-based insurance coverage that rewards you financially for being a safe driver or living a healthy lifestyle, you have to provide the data that proves it.
Right. They aren't just going to take your word for it.
Exactly. It demands a level of continuous data sharing that requires immense consumer trust. But the competitive pressure is so intense that the technology is advancing regardless. And traditional insurers have realized they just cannot build this infrastructure on their own.
Which brings us to this fascinating structural shift in the industry. Traditional, century-old legacy insurance companies have massive capital, right? But their internal staff is made up of actuaries and risk analysts, not software engineers and AI developers.
Right, they're math people, not tech people.
Exactly. They don't have the internal capability to build these dynamic hybrid policies or real-time IoT networks. So their solution is to form an alliance with the very InsurTech startups that initially set out to disrupt them.
Yeah, the relationship between legacy giants and InsurTech startups has really evolved from pure competition into a highly pragmatic, mutually beneficial symbiosis.
How so?
Well, startups bring the necessary agility. They develop the innovative AI algorithms, they understand modern digital architecture, and they excel at building highly intuitive, customer-centric interfaces.
But they have weaknesses too, right?
Huge limitations. They lack the massive capital reserves required to actually underwrite catastrophic risk.
Yeah.
They don't have the deep regulatory expertise needed to navigate multiple international jurisdictions, and they lack an established customer base.
I'm really glad you brought up the capital reserves because the typical business narrative is always about agile tech startups destroying slow legacy industries.
Right, the classic disruption story.
Yeah, but in this scenario, the startups are effectively acting as an outsourced R&D department for the giants. Because if an InsurTech startup builds a beautiful smartphone app that uses AI to process a property claim in 3 seconds, that's incredible.
It's great tech.
But if a catastrophic hurricane wipes out a coastline, that startup doesn't have the billions of dollars in liquid capital required to actually pay out those claims.
And that is exactly why the legacy insurers hold the ultimate power, because of those capital reserves and their established regulatory moats. But simultaneously, the legacy insurers are entirely dependent on the startups to remain relevant to the modern consumer.
So it's a true partnership of necessity.
Absolutely. The process transformation these startups facilitate is essential for survival. By integrating startup technology, legacy companies are completely rethinking how they assess risk, how they engage with customers, and how they automate their claims processing.
And from the consumer's perspective, this partnership is what enables the personalized service they now expect, right? We're talking about on-demand insurance, usage-based pricing, and instantaneous claims processing.
Exactly.
By partnering with these agile startups, legacy companies bypass the need to spend 5 years and tens of millions of dollars trying to build these solutions from scratch internally. It drastically reduces their time to market.
It accelerates deployment significantly, yeah. But, and it's a big but it also introduces profound internal friction. Integrating the technology of a fast-moving software startup with the core operations of a historically conservative, highly regulated legacy insurer is incredibly difficult.
Oh, I bet.
Implementing an AI algorithm is straightforward. Changing the human behavior of a century-old corporate culture is a massive undertaking.
Let's break down the practical reality of that friction. The sources highlight specific steps needed to overcome these cultural barriers. They mention adopting an agile mindset, retraining staff, and fostering a culture of experimentation. But how exactly does a massive company successfully tell an underwriter who has relied on static historical charts for 30 years to suddenly act like a Silicon Valley developer without completely breaking their core daily operations?
It's tough. The most successful approach detailed in the transition strategies is a dual-track system.
What does that mean?
Well, legacy companies cannot simply flip a switch and disrupt their core revenue-generating operations. Instead, they establish isolated innovation hubs, essentially funding their own internal startups.
Ah, okay. So they're somewhat siloed.
Exactly. These hubs are given the freedom to experiment with new digital infrastructure, test AI integration, and fail without threatening the larger company. And as these agile processes are refined and proven successful, they're systematically integrated back into the core business.
That makes a lot of sense.
But crucially, this requires heavy investment in continuous staff education. The workforce must understand that AI and automation are not there to replace their jobs. They are there to remove administrative bottlenecks, allowing them to focus on complex risk analysis.
And they have to manage this massive internal cultural shift while navigating an external landscape that is constantly throwing new hurdles at them.
Oh, the hurdles are endless.
With all this continuous IoT and wearable data we've discussed, insurers are suddenly holding a terrifying amount of real-time personal information. Navigating new global data protection regulations becomes a daily challenge. Add to that consumer expectations demanding total transparency and lightning-fast digital interactions.
The regulatory and consumer pressures are immense, but the ultimate catalyst forcing this digital transformation is climate change and sustainability.
Right.
The fundamental premise of traditional insurance, relying on the past to predict the future, is becoming obsolete in the face of shifting global weather patterns.
Because if the frequency and severity of storms, wildfires, and floods are fundamentally altering, those 100-year historical actuarial tables we talked about earlier are no longer reliable.
Exactly. The historical data is losing its predictive value. Underwriting modern climate-related risks requires a deep understanding of long-term environmental implications.
So what's the solution there?
Insurers must rely on real-time satellite imagery, continuous climate sensor data, and incredibly sophisticated predictive AI modeling to understand what will happen tomorrow, rather than looking at what happened yesterday.
Wow.
The insurers that successfully embrace this digital transformation, adapt to intangible assets, and restructure their cultural mindset are the only ones equipped to survive this new reality.
That perfectly encapsulates the incredible structural shift we've explored today. We started by unpacking that massive 17% coverage gap, highlighting the industry's struggle to protect invisible, intangible digital assets.
Yeah, that huge blind spot.
We looked at how the sharing economy and soaring cyber threats are forcing standard personal policies to adapt to complex commercial risks. We explored the mechanisms behind continuous data, how wearables and AI sensors are shifting insurers from passive safety nets into proactive risk managers.
Right.
And finally, we broke down why the survival of this industry relies on a culturally complex alliance between century-old legacy capital and agile InsurTech innovation.
The entire ecosystem of risk is basically being dismantled and rebuilt in real time.
Which brings me to a final provocative thought for you to mull over as we wrap up. We've detailed how AI, wearables, and interconnected sensors are giving insurers unprecedented continuous insight into our personal habits and operational risks.
Yeah.
If this technology eventually advances to the point where insurers can predict individual risks with near-perfect accuracy, if their algorithms know exactly who is statistically guaranteed to fall ill, or whose driving habits will inevitably lead to an accident, does the fundamental concept of shared risk completely disappear?
That's the big question.
Does insurance stop being a communal safety net where the many pay for the unpredictable misfortunes of the few and simply devolve into a highly personalized, unavoidable subscription fee based on your exact lifestyle choices? Something to think about. Thanks for taking this deep dive with us.